Good afternoon and evening, everybody, or good day if you're just watching the recording later this week. Thank you for listening in and joining us this evening, looking at Fibonacci levels, and not only levels on the chart, but just what is the Fibonacci sequence. And we have Tarek Saab here, who's the owner of Fibonacci.com, who's going to really explain to us what this sequence means, what the levels are, and how you can use them in technical analysis. So quickly, as always, we'll go through our quick disclaimer. Anything that we talk about is not going to be buy or sell signals or any advising, anything like that. It's really going to be, especially this one, focused on just how to draw fib levels, different areas to watch for, measured moves. And so this is kind of a different way of thinking. And Tarek's been showing me a lot of different ways to use these levels. And I found some really interesting stuff, and everyone's going to use these levels a little differently, but these are just going to be the ways he uses them and different ways that you may be able to use them as well. So before we get to that, just quickly for those that have not heard about TrendSpider, we are a new charting platform that allows you to do a lot of cool, innovative, and unique things that most charting platforms do not allow. And that ranges from the ability to automate different levels, such as fib levels, and create just a more streamlined approach to technical analysis. So we are going to focus on drawing those fib levels on TrendSpider tonight, and how you can do that with your account or your free trial if you do sign up. So some of the problems that we're aiming to solve are a lot of emotional things. So removing bias, removing the kind of impulse, the impatience of just wanting to trade. We do this by the automation side of things, the alert side of things, and I'm going to focus on the alert side of things, especially on these fib levels tonight, where you can actually capture some of those wicks that may not make it to a specific area or specific price level, but you're able to capture that through the sensitivity alerts. So, I'm really going to just hand it off to Tarek at this point. We're going to focus on really the automated TA side of things, showing you guys how you can automate some of the Fibonacci levels with the different TrendSpider trendline functionality, such as, wick to wick, body to body, that type of thing, creating the alerts around these levels, and then touching on raindrops as well. Looking at raindrops around some of these levels are pretty interesting. So without further ado, I'm going to hand it off to Tarek. Thank you so much for joining us today, and I'll hand it off to you so you can share your screen now.
Thank you, Jake. Really appreciate it, and thanks to all the guys at TrendSpider for making this happen. Let me go ahead and expand this a little bit about me. I have been technical trading now for about 10 years. In addition to Fibonacci.com, I also own Texas Precious Metals, and I have been trading in predominantly the futures markets for a considerable amount of time. And as I trade, I have gravitated to this just amazing set of ratios known as these Fibonacci ratios. They are a tool in the toolkit. They are not the end-all be-all of technical analysis. Meaning that I certainly use a wide variety of other indicators. It's just that Fibonacci has become a core part of trading for me. We're going to talk about three things today. What is Fibonacci? How is it used? And why does it work? Or at least why do I think that it works? I want to, preface what I'm about to say by just letting you know, my introduction into Fibonacci. I first remember Fibonacci or coming across Fibonacci in college, actually. So I had a double major in liberal arts and electrical engineering. And I distinctly remember having days where in the morning I was in a humanities lecture listening to different artists from the Middle Ages, Leonardo da Vinci, Michelangelo, and how these men used the golden ratio, which is derived from Fibonacci numbers, in their artwork, and the manner in which they aspired to sort of quantify beauty through measurement. And then in the afternoon, I would go to my electrical engineering class, and we would use phi and the Fibonacci constant in certain calculations. So when I started technical trading later on in my career, I was again shocked to discover that Fibonacci was again used in this discipline. And to me, my instinct was that there's got to be something special about this sequence or this ratio because of how pervasive it is in multi-disciplinary aspects. So with that, let me give you a little background on Fibonacci. Many people think that Fibonacci is a man. Actually, the gentleman that reintroduced this sequence to Europe was a man named Leonardo Pisano. He was a famous mathematician in the 13th century. He wrote a book called Liber Abaci. He's responsible for bringing the Arabic numerals to Europe. Prior to Pisano, Europe was still stuck using Roman numerals, and a lot of his work and his math texts are what is responsible for double entry bookkeeping that occur later in the Middle Ages. The Fibonacci sequence and its ratios, as I mentioned, have been discovered in a wide variety of applications from nature and art and music and biology and other disciplines. And again, I think it's important for any technical trader just to kind of understand the background of where we get these ratios from. And when you log on to TrendSpider and you attempt to add your fib lines to a chart, you're going to see a series of ratios that seem somewhat random. I want to get into how they are derived so you can get a sense for why they may be meaningful and impactful. So with that, let's start with what the Fibonacci sequence is. When we're talking about the Fibonacci sequence, what is that? Well, we start with the number 0, and the next number in the sequence is the number 1. And if you add 0 plus 1, you get 1. Pretty basic. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 5 plus 8 is 13. And you kind of get the pattern. Basically, what we're doing is we're taking one number and adding it to the previous number and coming up with a sum that is the successive number. Okay, so 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and on it goes to infinity. Now, if we attempt to depict that same pattern with a picture, we arrive at this picture. And I'm going to explain what this is. Each of these little boxes represents what we just did. So 1, 1, 2, 3, 5, 8, 13, 21. These boxes represent areas that coincide with the numbers in the Fibonacci sequence. Now, this box is very significant for two reasons. One, you can see obviously that there is a spiral that is produced by connecting the intersecting blocks with each other. This spiral, we're going to come across this again in nature, but this is what is known as the Fibonacci spiral, okay? And the second reason why this is important is you'll notice that in each of these boxes, when they're laid next to each other, perhaps the biggest box is the easiest one to demonstrate this, you'll see that this line intersects at a certain point in the line above perpendicularly. You notice that it's not at the middle, it's at a certain point. And that point will repeat over and over and over again as the spiral goes on off into infinity. And I'll get to the meaning, why that is meaningful in just a minute. So with that, I mentioned that the Fibonacci sequence is pervasive in nature. Here are just a very few examples. I could give you about 100, 200 examples pretty easily, but just the sunflower, you'll notice pretty much all sunflowers have 89 clockwise and 55 counterclockwise parastaches. These are Fibonacci numbers. So many flowers in the plant kingdom have petals that coincide with Fibonacci numbers. In this case, the passion flower has 3 sepals and 5 outer green petals. The daisy, most daisies have either 13 or 21 petals. You'll see this in marine life. So that spiral, that Fibonacci spiral that I was just showing you is the same ratio as what we see in the nautilus shell or in snails and various crustaceans, both in marine life and on land. And ram's horns also follow the Fibonacci spiral. This is an aloe vera plant, which also follows that Fibonacci spiral. So you can see that it's just everywhere. The DNA spiral also follows the Fibonacci spiral. So in human biology, we're very familiar with the spiral patterns of both hurricanes and galaxies. They have been known to also follow the Fibonacci ratios. I'm going to give you other examples as we go on, but just pausing here, I mean, in the plant and animal kingdom everywhere, like I said, I can give you 1,000 examples of where these Fibonacci numbers appear. So when we talk about the ratios, we've just discussed the numbers. You've seen the sequence. These numbers have significance numerically in nature. But what about the ratio of those numbers? So you see in this example, I have an arrow that's going from right to left. That means that I'm taking the higher number and I'm going to divide it by the number before it. Okay, so in this example, 1 divided by 1 is 1. 2 divided by 1 is 2. 3 divided by 2 is 1.5. So we'll pause here. At this point, there doesn't seem to be much of a pattern. This is very early on in the Fibonacci sequence. As the numbers progress, as we continue this process, you're going to see that these numbers begin to coalesce around a single number. And from 89 divided by 55 onward into infinity, this ratio of one number divided by the previous number is going to land at 1.618. And this is what we refer to as, in engineering, it's phi as the Fibonacci constant. And it's this happens to be the uppercase form of that. Now, what happens if we reverse that arrow? Okay, so rather than going from the higher number divided by the lower number, this time we're going to divide the lower number by the higher number. Okay, we'll start towards the middle of the sequence. As I mentioned, as you go deeper into the sequence is when you get closer to the constant. So 8 divided by 13, 0.615, 13 divided by 21, 0.617, and then you go down the list. And what do you notice? The numbers coalesce around 0.618. Now, what I find fascinating about this is not just that, again, we have another constant, but the similarity of that constant. So if you look below here, if I take the 1.618 that we arrived at previously, and I drop the 1, you replace it with a 0, and now this is also a constant. Instead of the uppercase Greek letter phi, you have a lowercase Greek letter phi. This is also a Fibonacci constant. Okay, so here we have two numbers, 0.618 and 1.618. These ratios are both derived from the Fibonacci sequence that begins 0, 1, 1, 2, 3, 5, 8 and continues into infinity. Okay, so this is a foundation. This is an important, these two numbers are very significant. You're going to see this as we do some charting a little bit later on. Now, if you've heard of the Greek mathematician Euclid, where we get Euclidean math or Euclidean geometry, he posed to himself a puzzle. He was curious. He said, if I draw a line, a horizontal line, like what you see on screen here, he wanted to know at what point in that line would he find the point where the smaller portion of that division, the ratio of that smaller portion to the larger portion is equal to the ratio between the larger portion to the whole. So let me do that again. The ratio between the smaller portion to the larger portion is equal to the ratio of the larger portion to the whole. And what point is that? It is 0.618, the same point that we just looked at when we did that division of the Fibonacci sequence. It also happens to be the same point in that earlier slide with the Fibonacci spiral and all those boxes. Each of those boxes intersect at 0.618. It's known as the golden ratio. And as I mentioned at the outset, in my humanities class in college, we would often discuss the golden ratio in art. And so here are some examples. This is the Greek Parthenon. You can see the dimensions of the Parthenon follow almost exactly the dimensions of the pictorial representation of the Fibonacci sequence. This is a Stradivarius violin, considered to be the most beautiful instrument in the world. And you'll notice as we look at the dimensions between certain aspects from high to low and where the base of the strings are and so forth, that all of these ratios all correspond to this 0.618 golden ratio. So we see it in architecture here. We see it in music. I haven't put a slide in here on this, but if you look at the keys of a piano, how are those keys separated? Well, you have 2 black keys and then 3 black keys. So those are Fibonacci numbers. 2 plus 3 is 5. So you have 5 black keys and you have 8 white keys. And so when you take all of the keys together, you have 13 keys. Again, those are all numbers in a Fibonacci sequence. This is the image of the Mona Lisa. Many art historians argue that the ratio here, if you look from the chin to her to the top of her head, and you draw that spiral down to her wrist, that the pattern tends to follow the Fibonacci pattern. This is Dorophorus. It's the famous statue from Greek antiquity that was symbolic of the perfect ratio of a human being. And it's interesting, knee to foot here in the statues, the golden ratio. And then from the neck to the navel, also golden ratio. So just a few examples. Again, I don't want to belabor the point here, but there is some tremendous significance to that number. Now, you'll notice, tying this back to technical trading, when you look at the Fibonacci levels, when you log on to TrendSpider and you want to apply them to the chart, the numbers that are there are not just 0.618 and 1.618. There are other ratios there. So when you see those other ratios, what are we referring to? Well, before we looked at the ratios of numbers that were in sequence. Well, what if we skip a number? So what if instead of 21 to 34, instead of that ratio, both forwards and backwards, we look at the ratio between 21 to 55, both forwards and backwards? And what's interesting here, again, when we skip numbers, is again, the ratios are all the same. You continue to land and coalesce around this number 0.382 when you skip and you divide 21 by 55, 34 by 89, and so forth. So 0.382 is also a Fibonacci constant. It is a Fibonacci constant derived by a different set of numbers. And when we go in the other direction, we get another Fibonacci constant, 2.618. Now, what's significant about that number? Again, we see this recurrence of 0.618. So we have 0.618, 1.618, 2.618, and those numbers are all derived from various ratios along that Fibonacci sequence line out into infinity. Now, for the purposes of this presentation, I'm going to leave it at that. As far as how we calculate all the ratios, there are other Fibonacci ratios, 0.236, 0.786. Those are also derived in the same manner. You just, instead of skipping 2, you might skip 3. And that's so when you see that whole list or that catalog of different Fibonacci ratios in your trading software, that's how those numbers are derived. If you want to learn more, not on the technical trading side, but just the background of Leonardo Pisano, the background of how these Fibonacci numbers are pervasive in nature and in music and art and science and biology and so forth. This book, Master Fibonacci, was written by Shelley Allen. I wrote the foreword to it. It's available for free download on my website, Fibonacci.com. So you just register and you can download the whole thing in a PDF. If you like a printed version, they're also available on Amazon. So we've discussed what is Fibonacci. Now we're going to talk a little bit about how it's used. Okay, this is where we start having some fun with the charts. Before we jump into the charts, I want to talk about how we apply these Fibonacci ratios or these levels. You're going to see this when we do a real world application on the chart, but just to mechanically go through the process, I want to start with the first two numbers in the Fibonacci sequence, 0 and 1. We would plot those horizontally on a line, and they can be as narrow or as wide as you want. You're going to see as I go into the application of this that 1 is always applied at the peak and 0 always applied at the trough of whatever high and low you're looking to analyze. And you'll see that in just a minute. Now, the next Fibonacci ratio is 0.5, and you'll say, well, wait a second, I didn't see that ratio, or I don't remember that ratio. There's only one time where 0.5 shows up in the Fibonacci sequence. It's when 1 is divided by 2. Some will argue it's not really a Fibonacci number. I don't have much of an opinion on that, but I do always plot it. I do think that it's significant. A 50% retracement is good to see on the chart. So I always plug that one in there. The point here is that the more important Fibonacci ratios are 0.382, which we just saw how that's calculated, and 0.618. Those two are vital. In fact, the 1, the 0.5, and the 0 here are grayed out. If you were to produce a chart and just put 0.618 and 0.382 on the chart, that would be a great starting point. As I mentioned, there are some other Fibonacci ratios if you want to get very granular with it, and I often do. I add 0.786 and 0.236 also on the chart. Okay, so we have a series of horizontal lines here going from 0 to 1, and then you have some fractional areas of horizontal ratios between that 0 and 1 marker. Okay, now when we talk about Fibonacci in this application, they're referred to as retracements. That means that 1 is the peak, and we are retracing that run up down to 0 and coming back up to these certain Fibonacci lines. Okay, so anything below the peak is referred to as a retracement number. What's really interesting to me as far as applying Fibonacci and where I've had a great deal of success in my trading career has been also paying very close attention to what are known as Fibonacci extensions. So you have retracements, that is below the peak, and you have extensions, what above the peak. So if you are monitoring, let's say the S&P 500 and it's breaking out to all-time highs, where would be an area of likely resistance or an area where the chart might pause? And what I have discovered in my trading career is that typically these extensions, these ratios that are greater than 1, tend to be significant areas on a chart. So let's take a look at it now. Okay, so this is a chart. This is a weekly chart of the S&P 500. I'm using the SPY ETF here. Okay, now what I've done, let's take a look at the chart. I've started my Fibonacci ratio at the peak. So this is in 2007, 2008, right before the March 2009 lows and the great financial crisis. So that becomes my 0 and 1 line. All of these other lines that are plotted in between are Fibonacci ratios. So what's significant here? Well, the first thing that I would point out is as we come up off of the bottom, the first area of support in this retracement is 0.236. Then the chart zooms higher all the way up and stops on a dime right at the 61.8% Fibonacci retracement. It then pulls back. Where does it stop? It stops at the 38.2% Fibonacci retracement. Then it moves forward again. And where does it stop? At 78.6. And then it pulls back. And where does it stop? Right at the 50%. And then it moves forward and pushes all the way back to the peak. And in about April of 2013, we were able to recover the highs. It took us about a little over 6 years to get back to where we were in the S&P 500 prior to, back to the S&P 500, basically back to the prior highs here, okay? So now what I want to do is I want to ask the question, where are we going? If we break out above the prior highs, where is a likely area that we can expect the S&P 500 to go? Well, let's take a look. We're going to zoom out of this chart. Now, this chart right here only went up to about April of 2013. So we're going to look at the same chart now. This was the peak. This was the trough. And this is zoomed out. And here we were in the prior chart. So we start here. What happened? Well, S&P broke higher, and then it pulled back and retested that breakout. That's a very common move in technical analysis. You break out and you retest. Now, once you retest, I mean, this is a great entry for any technical trader. Okay, you're retesting the old highs. What you would do is you take a long position here, and you'd set your stop right below that prior, or right below the prior high there. So that would be an area where you would say, hey, if we fall back, maybe it's a false breakout. I want to get stopped out there. But that would be a great technical position here to go long here and set your stop right below. Well, in this case, if you did just that, you went long here at the retest, where would you want to take profits? S&P 500 from about summer of 2013 through January and even into the midsummer of 2015 was just zooming higher. What do we notice? Where does the chart stop? It stops right at the 1.618 Fibonacci extension. I mean, it comes up, it tests once, twice, 3 times, 4, pulls back, 5, pulls back, 6, pulls back, 7. 7 times it attempted to break above the 1.618 Fibonacci extension, couldn't do it. So this was an area of resistance. So if you were to place a trade here, you would go long here and you'd look to start taking off your position right around this level because it's a likely area of resistance. Now, if I were to pull all these lines off of the chart, there would be no reason whatsoever why any technical analyst would say, well, this is going to be an area where there's going to be a significant long-term pause. In this case, it was greater than a year. But if you're applying Fibonacci levels, it becomes increasingly clear. So what happens? Well, we break out, we retest as expected, and then we continue to push higher. And what you're looking at over here, let me add some of my arrows. That's what I wanted to show you before. So here we are. Came up here, we peaked in January of 2019. We pulled back in December of last year, and we came back and retested the highs. We've pulled back a little. The activity and the action here is very similar to what we saw at the 1.618 Fibonacci extension. You came up here and you paused. This is an area of resistance. Next slide. So this is a slide of Starbucks. It's the monthly chart. And I have not applied any Fibonacci levels here. So if you just look at the chart in a vacuum, what jumps out at you? Well, it's hard from a technical standpoint to really make a whole lot of sense. You have somewhat of a trend line here that comes along this way. You have a trend line going up. It's sort of a big megaphone pattern. You might see some type of ascending triangle potentially. But when you apply the Fibonacci levels, I think the picture comes into focus a little bit better. So here we are. And what do we see? Again, just like the S&P 500, you peaked in 07, you troughed in 09, and then you make this magnificent run up. The first real pause in that run up occurs where? Right at the 61.8% Fibonacci retracement. You pull back to 50%, and then you push back immediately to the new highs. You break out. This time you don't have a pullback, and you push all the way higher. Where does it stop? Right on a dime at 1.618. Pulls back pretty much the entire way, pushes forward. This time it's pretty remarkable. I mean, there's a great deal of momentum behind Starbucks at this point. Pushes all the way through, doesn't pause at 2.618, breaks through and comes back, but it stops at 2.618. It comes back, and this becomes, while it wasn't an extreme area of resistance because of the momentum behind the chart, it did serve as a significant area of support. And so what have we seen from that point until now? It's thrust higher. It's broken through 4.618, and now it's come back to kind of retest that line. So I published a chart on Twitter, and I said, look, looking at the chart, this looks bullish to me. I would recommend, I mean, disclaimer, there are no recommendations here, but for me, from a risk reward setup standpoint, in this area right here, if you were to take a long position, you could very easily just set a pretty tight stop underneath that 4.618 line and see if 4.618 acts as support just in the same way that 2.618 did. Okay, so next chart. Oh, here are the arrows. I meant to add that along in the process. Okay, so this is the chart of the TLT bond ETF. It's a 20-year Treasury ETF. Now, I put this chart on here specifically because I don't think that this is a great application of Fibonacci levels. In fact, if you go online, you'll see some detractors of Fibonacci who say, it's just happenstance that, certain moves will stop at certain lines and so forth, that there really is no order to the chaos. And if you look at this chart and the way that this is applied, you might agree with them, right? You see, you started at the peak, and then you drew your fib line down to the trough, and all of the key levels, for the most part, it's a little bit sloppy in all these areas. You don't have a tight stop at 0.382. You don't really get all the way up there. It's noisy, or as I like to say, the picture is out of focus here. And you say, how can I create a little bit better focus? Why is this chart not coming into focus in the same way that, say, the S&P 500 or Starbucks did? And there's a little technique that I have employed, and I'm borrowing from Connie Brown, who is a legendary technician, who recommends that sometimes you have to use the secondary high as your starting point, as opposed to the primary high. And an analogy that I use here is, the rhythm or the patterns of Fibonacci are just that. There's a very distinct rhythm that you want to find and participate in. It's sort of like music and dancing and finding the beat to the music. And every now and again, you'll have a situation like here in TLT where you have this phenomenal spike higher that is way overbought. You can see that you had a gap up and another gap up, and it's like a lightning bolt for a split second, then it comes right back and pulls back. Well, if we continue with the analogy of sort of the rhythm of the market, this is more of a cymbal. Okay, this is not the bass drum. This is just sort of a big loud clang. And so I have found that sometimes when you get those big loud clangs, that's not the greatest starting point. A shelf like what you see here, if you can see my arrow, is a more likely area where this is sort of the real area that the chart is topping in. So if we apply our Fibonacci levels to that area instead of the symbol, let's see if we can better dance to the rhythm or put the picture in better focus. So we do that, and boom, all of a sudden, now things start making a little bit more sense. So we have the spike down. We have the first stop is right at the 38.2% Fibonacci retracement. We pull back, and we have another stop right at the 61.8% Fibonacci retracement. And then we start tap dancing. We have some support here at 38.2. We break it, then we come back. We have resistance at 38.2. And then we come back, more resistance. We finally break through. It becomes support, again, right at that level. And then we burst through. We stop at 78.6, and then we find support at 61.8. So this is really tightly following the Fibonacci levels in my view. And here we had this huge gap up. We break above what I suggest here is the high, even though it's not the absolute peak here. It's the shelf. We break up above that shelf. And then we close successively right below the 1.236. We shot up intraday or intra-week in this case, a little bit higher, but we close below that low. We break down. We don't find support at that prior, the first time anyway, the prior breakout area. But we push back up, and now we have support there. So this pattern to me looks like you have a breakout, you have an A, B, C correction. And, to me, again, looking at this level as the key level, this is where you'd, if you're placing a trade on this, you'd put your stop here right below the low from the prior week, and you'd look potentially for a move higher off of this level. And again, all technical trading is about risk reward. There's no guarantee. You could easily fall through here, but it's about measured risk and how Fibonacci helps you to refine that a little bit. Last slide that I want to show you on as far as a chart goes is this is the same exact chart of TLT. This is the ABC correction I just pointed out. This is the tail end. This is the daily chart now beginning in September. And what I have done is I have applied Fibonacci from the last peak or the peak in early September down to the recent trough in the second week of September. And again, Fibonacci here is very applicable. The point being that you can apply Fibonacci levels to any peak and trough, and oftentimes you'll find that the numbers either overlap with each other or provide greater granularity. So here we look at the peak from the beginning of September. If you're more of a swing trader and you're only putting on positions for a week or 2 weeks, you come down here to the trough, and now you move back up. Where's a likely area that you might have some resistance? Boom, right at 61.8% Fibonacci retracement. You have your support at 38.2. You go back up, resistance at 78.6. You come back here, and you have what I believe is probably likely support at 23.6. Not to say that we couldn't come back here, double bottom. Could certainly do that. But this is an area where all other indications, if you have some other tools that you're looking at, it might be an area where you want to look to go long. So we talked about what Fibonacci is, giving you a few examples of how it's used in a chart. And then lastly, just very briefly, I want to touch on, why does it work? And, I've thrown a lot at you today in the presentation. I've talked about biology and art and music and everything else. And you think, okay, wow, that's pretty neat. It's amazing how nature works and so forth. But why would it apply to technical trading? Like, where is the connection between that and price action in the chart that, it can at times be seemingly random? The answer is nobody really knows. I don't think there's a definitive response that has been measured and tested. But I do have a theory, and I think that theory is behavioral economics. In fact, Jake, at the outset of the call today, mentioned that one of the advantages of TrendSpider, one of the ambitions for the team, is to take out some of the bad behaviors that are a result of our human biases. and behavioral economics and human biases are a subject that I have studied at great length. Some examples of this are loss aversion. So just a quick example is like people's tendency to avoid losses is much greater than their desire to make gains. So there's a statistical, quantifiable reality, and that is that the feeling of losing $100 is literally twice as bad as the joy of making $100. That is quantifiable, it's measurable, it's been tested. And I find that to be utterly fascinating because as human beings, we are irrational and we are consistently irrational. And even if we know what potential irrationalities that we have, we still fall into those traps just by our very nature. And there are just literally dozens of these biases. Some are anchoring bias, confirmation bias, recency bias, normalcy bias, and many more. I'm not going to get into all of them here. My only point in this slide is to say that we have these biases that cause us to act in irrational ways that are actually highly consistent, even though they're irrational. And I tend to believe, my theory here is that the Fibonacci numbers, for one reason or another, when price moves from 1 down to 0 and retraces up to about 61.8%, for some reason it triggers something in our behavior to want to take some profits there or to take positions off. Why that is, I don't know. And I think you can make a case for the other levels as well. It's something, in my old age, I would love to devote a lot of time to studying and testing. But I think that there is a distinct correlation between market behavior and the behaviors in the natural world and the animal kingdom, et cetera, et cetera. And if you want to read more about that, I thought I'd throw up a few good books. The seminal work is Daniel Kahneman's Thinking Fast and Slow. That's a thick book. It's a tough read. But some of these others, like Your Money in Your Brain, and an especially good one is Thinking in Bets by Annie Duke, which recently came out, touches on a lot of behavioral biases. She's a very famous poker player, and the same behavioral biases that we see in the markets are also applicable to poker. And then Michael Lewis is The Undoing Project. So I want to throw a few out there in the event that you're interested in behavioral economics, because I do think that they support the case for why Fibonacci is so significant in technical trading. So with that, let me stop sharing my screen here, turn it back over to Jake, and appreciate your time.
Awesome. Thank you so much. We had a question. How much difference does a log scale make when drawing fibs?
It really doesn't, actually. In fact, when the charts that I just put on were log scale. So when you start getting out in time and you go to monthly or even long-term weekly charts, I'm always using log scale for the most part. And what you'll find sometimes, particularly if you're looking in narrow ranges, is the arithmetic scale will trigger maybe a different Fibonacci line than the log scale will, but there's this amazing consistency between the two.
Perfect. All righty. So I'm just going to share a couple examples here, and this is the exact same chart that Tarek just showed. But what I wanted to show here was you can see that at the 2.618 extension, we didn't actually get to the penny there. And this is where alerts really come into play. So for example here, instead of missing this kind of move, topping out at a couple different points here before pulling back quite hard, you weren't able to kind of capture that we were near this area. If you right click and create an alert at this line though, you're able to essentially increase or decrease the margin of error around that extension, that 2.618 extension. And you can see now I'm able to capture some of those wicks that I wouldn't have been able to capture if I was just looking at that exact line. So this is something that's really useful when using fib levels and other types of upper indicators like moving averages or trend lines, where you can capture that margin of error. You can say, alert me when the price touches anywhere within this purple area. And then you can say, alert me whenever the 4-hour candle closes in this area. Now, the reason why we can't go below the 4-hour on the confirmation candle here is because we're already on the monthly candle. So, when we are looking at such a long time, the confirmation candle will get bigger. So in this case, whenever the 4-hour candle closes in this area, that's when you'll be alerted. And remember, these candles are months. So, these wicks could last for days. And so that's how you can really utilize the sensitivity alerts, creating a zone around these important levels. And, that's just one example. Tarek was showing me a couple different examples of using the 618 extension. And so I was like, okay, well, let's check out Microsoft. And you can see how well this area has been respected up to the 5th extension here on the monthly candle. So what I did was I just took the measured move from the financial crisis in 2007 to 2009. This is the original move 1 to 2. And you can see how well the price action respected these areas in between the 0 and 1 before finally breaking out. And you can see literally even after about over 10 years, this extension is still in effect with the this being 5 extensions out of the 618 area. So you can see we've tested this area 4 different times, and it will be interesting to see if there's a breakout or a possible move down.
Jake, if I could just interject one thing, I really want to reiterate a point that you just made because I think it's so important. And that is, in technical analysis, we always say, we draw with crayons and not pencils. And the point that you made about looking at zones or areas like what you have on the chart there, that sort of red zone, is so important. I mean, when we are applying Fibonacci levels, it's not necessarily to the exact tick, the exact penny every single time. There's no technical analysis that is going to be that refined. Really what we're looking for are zones, areas of key support and resistance where we want to begin looking at taking some action and setting up more favorable risk rewards, but not necessarily top ticking or looking for pennies. We're looking for dollars here. So I think it's just such a salient point that you made, and I want to reiterate that.
All righty, thank you. So we have another question from Kevin. Is it always best to go from high to low?
Different people do it different ways. You can go from low to high as well. Another thing that I would point out is that you have a lot of latitude with respect to where you actually apply the levels. So there are certain Fibonacci charts. For example, what I just demonstrated to you, I went from 0 was at the low and 1 was high, and in between we had 0.236 was sort of the very first level on the bottom side, going all the way up to 0.786. There are a lot of Fibonacci traders that have that reversed, where you'll see the 0.236 up closer to the peak, and you'll go in the other direction. 0.786 is closer to the bottom. You can do both. You can apply it both ways. A lot of it is just personal preference. Some people will only chart the extensions. Some people will only chart the retracements. You have a lot of latitude as far as that's concerned. I also want to point out, and Jake, since you have your screen up right now, if you go ahead and right click on your Fibonacci levels, you can go ahead and edit some of the properties. I do think it's important that you take a look at you have the latitude to be able to adjust what levels you even want to see. So if you don't want to see 0 and 1 and you don't want to see 0.5, you can jump in here and uncheck whatever Fibonacci levels you don't want. Or if there is a Fibonacci level that is not listed here, you can go ahead and put your own level in there. There's a lot of editing that you're able to do in the system that I think is also really valuable, and you just kind of make it unique to your own personality.
Yep. And one thing I want to mention on top of the properties, that I'm glad you brought this up. Let's say that your fib levels are in a certain part of price action that you want to move the levels. So you can see here I have them on the right. If I wanted to move them, let's say to the the top left, you'll see how the numbers move to the right, the left-hand side over here rather than the right. So you have some flexibility. You can even move these to the bottom. So for example, here it says top left. I can go to bottom left, and you'll see now the numbers have moved below. So there's a lot of flexibility with making those values visible, especially depending on which screen you're using and how the price action is.
One thing that I want to also mention is that, given obviously the time constraints, we can't do a complete course on Fibonacci. I'm just talking about price action in this presentation, but I also want to point out that there are other ways that you can apply Fibonacci. You can actually go vertically. So you can apply Fibonacci time zones. You can do Fibonacci fans. There are a lot of different ways that you can apply Fibonacci. For me personally, I think if you are able to get very comfortable with just the horizontal levels that we're showing here in this presentation, that's 95% of the battle. And I think you'll go a very long way into making charts that sometimes don't make a whole lot of sense, bringing them into focus a little bit better.
And you can see here, this is interesting. You know, if we did break down, look at where that bottom was that we found before, right at this 1.618 to the downside here. So this is an example of the system finding a fib level and then extending to the downside. This would be a retracement here. And the same thing, you can see how kind of, you know, perfect this previous area of support is aligning with this new retracement area here at the 0.618 or 1.618. So, you know, the reason that we do this automation side of trend lines and fib levels isn't necessarily to replace what you're doing by hand, but it's there to kind of be a secondary perspective. So, you know, this is flexible. If I change this to original, which is more of a longer time period that we're looking between areas, you'll see how we're catching a bigger measured move here. So the system's always not going to find the exact fib you're looking for, the exact trend line. It's there to kind of, you know, say, hey, here's another way to look at it, or here's another measured move that you may have missed that you want to check out. So that's the way to use the automation, and really, you know, not making it an end-all be-all. It's just like anything else, another tool in the toolbox. So as you move down to the daily, you'll see that these fib levels then kind of change, and you can see a slightly different approach here. And so yeah, were you going to say something, Tarek?
Yeah, actually, I was going to say one thing quickly, but your chart that you just put up, I also wanted to point out another thing here too. But yeah, as far as going from 0 to 1 to the downside, the only disadvantage to that I see is, I mean, it just depends. I mean, if you're looking to short a stock, there might be some value to looking at the downside. For me, I tend to care more about the long side, or where we're going up. And so that's the reason why I place a lot of weight on the Fibonacci extensions, because I like to know where the moves are going higher, not necessarily lower. Now, if you tend to short a lot, yeah, there can be a lot of advantage to go in the other direction. On this chart that you just put up, I think this is sort of a classic example, Jake, of a way in which I use Fibonacci. So you have a trend line there. You actually have falling resistance. That's that red line that you see on the chart. The other one there.
Yep.
And that falling resistance almost coincides directly with that. Looks like the 61.8% Fibonacci retracement.
Yep.
And look at where price gapped up from there. So that becomes an area where you say, I have more than one indication. It's not just the resistance at 61.8%. It is also the resistance at the falling trend line. And so if I can get above both of those, you know, that's a significant level. And of course, it immediately jumps to 78.6 because that's sort of like the next key fib level. But I tend to use Fibonacci like I was showing in the TLT chart. I use it in multiple ways. I try to overlap my Fibonacci levels with also some of my standard trend lines, so that I can see where resistance coalesces or where support coalesces.
Yes, no, it's confluence is always nice to see. And we have another question, more about the relationship between the fib and human nature, aka why it might work with technical analysis. Before Tarek mentions anything, I'm just going to take a stab at the self-fulfilling prophecy. I think it becomes a self-fulfilling prophecy as enough people watch this area. It kind of makes the market in itself. So that's something that I've seen personally.
Yeah, I mean, I think there's some of that. My only sort of take on the self-fulfilling prophecy argument is that, you know, and this is just here's a statistic for you. I think there's something like 50,000 CFAs or some astronomical number of people who tend to trade fundamentally. And the number of technicians in the world through the CMT organization, I could be totally butchering these numbers, but it's something like 3,000 to 5,000 in that range. So, I actually think that the vast majority of money movement that is moving price action is happening through fundamental trades with large institutions, sovereign wealth funds, et cetera, and is not necessarily being moved by the technicians. And so until that changes and 95% of the world is trading technically, then I don't know that the self-fulfilling prophecy is going to overwhelm the market per se. Not to say that it doesn't have some impact, but I don't think that that is necessarily the driving force. And even I mean, recently in the news with all of the various brokerages lowering fees on trading, most of the individual traders that are trading their 401k or looking to buy Microsoft or sell Starbucks or what have you, they're not really applying technical analysis. Most of these folks, they're looking at financials or having a feeling or feeling strong about a particular area of the market. So I wouldn't overweight that, is all I mean to say. As far as the behavioral side of things, I don't know what the specific question is. My answer is simply anything that I mentioned is simply a hypothesis. I mean, there hasn't been a lot of research on this, but I think observationally, if we were to take sort of the scientific approach, use the scientific method, we are able to observe, and I think this even surprised Jake in some of our conversations, just how well these Fibonacci lines are being honored on a technical chart. And knowing scientifically the pervasiveness of Fibonacci in other areas of biology in the world, there seems to be a connection. So, we can derive these hypotheses, and then I think it's incumbent upon, the certain professional psychologists to try to see whether or not, you can turn these hypotheses into theories as to why this might be. But that just is, one man's take.
Beautiful. How well do fibs work on options contract charts? I would say probably not. Probably using the fib level on the common stock is what you'd say, right, Tarek?
Yes, I always chart the underlying instrument, and so I mean, obviously with options, there's there's volatility has a huge impact on whatever the risk reward analysis is that you're going to make. So when you're looking at a chart, let's say we're looking at a chart of Microsoft, and we find a level that we're really excited about, coincides with a Fibonacci level, you feel like it's an area of support, and you want to go long. That is one element of risk reward. It's literally, what do I think my downside risk is relative to my upside with the price movement on the chart? But with options, there's a whole different set of analysis on risk reward that you have to calculate. And one is the measure of volatility. How much am I paying for the volatility of this derivative relative to what I feel comfortable with from a risk standpoint? Because you can be right technically and wrong on volatility and not make the type of money that you think you would have had you just gone straight long the stock. So it's sort of a convoluted answer to your question, but and to put it in simple terms, I don't look at options contracts when I am charting. I'm just looking at the price action of the underlying instrument.
Makes sense. Well, we are almost at the hour mark. So before we go, I did want to go over just the roadmap for TrendSpider and what's to come. So everything that you guys saw on today's presentation as far as fib levels and alerts, these are all different features that you can check out in the pricing page, and each pricing plan is going to have slightly different variations in this. But the features that we do have to come, and we've had a lot of requests for this, the ability to do market scanning, the ability to make alerts on a whole watch list. So for example, if you want to follow a blue raindrop, instead of going through 100 charts, you can actually just put in market scanning blue raindrop, and you'll be able to find any charts that are showing that. Same thing with the watch list. If you have a watch list where you want to know when the MACD crosses to the upside, any stock in that watch list, you'll have the alert whenever the MACD crosses. Pattern recognition, so bull flags, bear flags, that type of thing we're working on as well in the last quarter of 2019. And into 2020, we will definitely be working on the data side. So getting new data, international data, brokerage integration, the ability to actually manually execute an order through the platform. So you're not actually having to, go to a different broker, look at your chart, and then make the trade somewhere else. We're really hoping to make the whole process streamlined from starting to draw the trend line to actually making the trade. So that's where we're going, and we're very excited to continue to innovate. But we do have a ton of different features that you can take advantage now of. And definitely, if you have any questions, please feel free to reach out. Once again, thank you so much for your time this Sunday. Thank you to Tarek for being a guest and sharing his knowledge about the fib levels. And you can use his coupon code FIBS15 for 15% off up to 12 months. So if you did an annual subscription, that's 15% off, or you did a monthly subscription, that's 15% off up to 12 months. So please make sure to visit his website, Fibonacci.com. And Tarek, is there anywhere else that people can follow you or kind of follow some of your research on fib levels?
Sure. I'm very active on Twitter. And so you can follow me on Twitter at Fiblines, and it's at FIBLINES.
All right, I just pulled it up, so I'm going to share that in the chat now, so you guys can make sure to check that out. And definitely, if you guys have any other questions for Tarek, you can reach out through his Twitter, or just check out Fibonacci.com and see if maybe your question is answered in his actual website with all the information he has there. That is it for tonight. Thank you all so much for joining. Tarek, thank you so much. I hope to do this again soon. This is really good information, and definitely hope you have a good week of trading.
My pleasure. Thanks so much, guys.
Thank you. Everyone have a great Sunday evening, and we'll talk to you soon.